Good evening, everyone. I'm very pleased to welcome all of you to this closing session, at the end, the closing session of the annual Crypto Asset Lab conference. First of all, very quickly, let me thank Paola Bongini and Ferdinando Metrano for inviting me as moderator, and also really congratulate them for the great success of today's conference. We had the uncommon opportunity to listen to many interesting voices and different approaches that explore the crypto assets, offering a truly multidisciplinary framework. Being a jurist and dealing in particular with the banking and financial markets law, I'm really happy that this conference ends with a plenary session focused on policy and regulatory issues. In fact, I firmly believe that the future of crypto assets and their greater or lesser development are strictly dependent on the regulatory choices that will be made and that have to be made in a short time. Of course, it's clear there are not easy choices, and in fact, crypto assets are one of the key issues in the current debate on fintech's legal and regulatory implications. The importance of this issue derives from the fact that crypto assets in general and cryptocurrencies in particular can have strong implications for the long-term stability and efficient operation of the financial system, nationally and especially globally. In fact, regulators, institutions, academics are working to find adequate rules to govern this type of innovation. And I mean adequate in the sense that they are able to draw a trade-off between the various interests at stake. Some countries, as you know, already adopted specific rules for crypto assets. And about a month ago, in the framework of the new European Digital Finance Strategy, a proposal for a regulation on markets in crypto assets, for France's MiCAR proposal, was published. And this proposal has already generated a lot of different opinions. So about this proposal, but more generally about how to regulate crypto assets, we want to debate during this session with very highly qualified, I have to say, speakers who will offer different points of view on the subject under discussion. So I would start without many other words with Marco Petracco. Marco Petracco is a representative of DG Joint Research Center, European Commission. Hi, Marco. Thanks for being here with us. Marco, would you give us a general overview of the new European Digital Finance Strategy to which the MiCAR proposal belongs? I think that it could be quite useful to start with this session with a general overview.
Okay.
So, Marco, the floor is yours.
Thank you. So let me see if the screen sharing works.
Perfect.
Okay. Okay, so good evening, everybody. As said, I'm Marco Petracco. I'm an economist, research officer at the Joint Research Center, the European Commission Science and Knowledge Service. And let me start by saying that I'm very glad to discuss developments in fintech and digital finance regulation in such a distinguished company and in front of such a large and experienced audience. And before delving into the subject matter, I just need to make two quick premises. One is, of course, the necessary disclaimer that what follows are my personal views and not institutional views. And if anybody wants, here is a full disclaimer. And the second is that as an applied researcher on financial stability at the JRC, I'm not involved in actual policymaking or writing of the regulations, but I do have an interest in looking at how fintech has been transforming and is going to transform the financial sector and the behavior of financial actors. And therefore, today, I would like to provide a brief overview of the tools and objectives in the digital finance package, and propose a framework to see how these are related to the necessities generated by structural changes brought about by fintech and digitalization of finance. And in order to introduce the framework, I'm going to take a short step back in time to mid-2018, when I was asked to prepare a lecture reviewing then current thinking on the future of fintech. At the time, the action plan from the Commission had just come out, and fintech had been the buzzword of financial and regulatory communities for most of 2017. All of the European supervisory authorities and other institutions concerned with financial supervision and consumer protection had been reporting on fintech and on crypto assets over the second half of 2017. And in fact, crypto assets and mining had also been occupying a rather large share of primetime news and web search activity over the time. Everybody was then trying to make sense of a few rather fundamental questions, ranging from completely basic issues, such as what was fintech, to understanding its capacity to bring about lasting and fundamental changes in the structure of the financial market and the behavior of financial actors. And a lively debate was being engaged between academics, stakeholders, and regulators on how this new phenomena should be tackled and what objectives should be privileged and should be pursued in doing so. And this debate included and still includes some voices arguing that hands-off approach would be best suited in order to avoid risking throttling this innovation. After 2 years in the appearance of the new strategy, I would therefore like, so to say, compare notes with myself of 2 years ago and see if the outlook which was proposed there turned out to be valid and how it could help understanding the choice of objectives and tools presented in the new package. Hello?
Yes, we are here. We hear you.
Okay, because my video has been cut. I guess that this was because of an unstable connection. I will go on without the video. So, as I was saying, after 2 years and the appearance of the new strategy, I would therefore like to compare notes with myself of 2 years ago and see how that outlook measures up today, and see how it could help understanding the choice of objectives and tools presented in the new package. So, 2 years ago, the consensus assessment seemed to be that fintech had a small size, but a strong potential for growth, like all digital innovation. And it had the potential for beneficial changes, especially in terms of allowing better access to finance and a more efficient financial sector. And it was widely believed that these benefits could be rather large. At the same time, given its growth potential and the systemic nature of the financial system, there was a concern that there could be unforeseen outcomes that could have far-reaching consequences. Naturally, notwithstanding the hype, some fundamental functions and needs that are the foundations of the financial system were not expected to change, even when conducted under new technology. And these foundations and needs respond to well-studied and well-known economic fundamentals, such as maturity transformation, liquidity provision, savings accumulation, or there are even tools such as lender of last resort and financial safety nets that are a part of our financial system that were not really expected to be changed fundamentally in their function from the new technologies. And so from this point of view, digitalization of finance appeared simply, so to speak, as a different tool to reach the same fundamental purposes and goals. On the other hand, although it might seem incredible now, it was just then becoming clear that when digital technology becomes applied to an existing field, some of its intrinsic characteristics, such as connectivity and scalability, can have unintended and unforeseen consequences. And remember, if you just think of the impact on social networks on democratic discourse, the Cambridge Analytica scandal had just been disclosed. Sorry, I will try, but this has been, hello?
Yes, we see you now.
Yes, yes.
Oh, okay.
We can see the slides and we can hear you perfectly. So
okay, thank you. So, so as I was saying, there was at the time an understanding that there could be unforeseen consequences from the applicability of these new technologies was starting. Say the Cambridge Analytica scandal was just from the beginning of 2018, and also think of the hyperscaling growth, which has been observed for some platform services, such as delivery, travel agent services, and taxis. All of these were being very actively debated, starting more or less from that time. And this left policymakers with an apparent conundrum, because fintech and digitalization could be considered too small to care or too risky to regulate, but it seemed that it had the potential to leapfrog some of the usual stages of development and become too big to fail or too big to regulate effectively. And this seemed to point out to a different conclusion, that given its transformative and growth potential, fintech should be treated instead as too important to ignore, notwithstanding its then small size. And now this consideration could seem to imply that there was, of course, a need to regulate and monitor the system to preserve market integrity and financial stability. And that would have been, by way of example, the point of view of somebody concerned with these issues, such as me. But on the other hand, as we said, there was another very valid point of view that this was a new technology with potentially transformative impact on the way of doing finance, if not on its fundamental functions. And it was also clear that this could imply substantial gains, and that taking a strong position too early really had the potential of closing down this source of innovation and losing out on future benefits. But worse still, the problem was that hyperscaling dynamics meant that taking a position too early could have a chance of cutting oneself out from the possibility of growing a large domestic player or developing key technologies that could become central in the future marketplace. And this has been witnessed, is a dynamic that has been witnessed with several other big tech phenomena. And this could be a risk of existential nature, given the central role of the financial system in the modern economy. As if it were not enough, these two objectives of maintaining market integrity and openness to innovation had to be pursued together with a third objective that is, or should be, a general objective of every regulator, that is, internal consistency of regulation and legal certainty. And unfortunately, the combination of these three grand strategic objectives is termed and was termed and is still termed the fintech innovation trilemma in academic literature. Market integrity, openness to innovation, and internal consistency of rules appear to be three objectives which cannot be pursued to the full extent at the same time. Now, 2 years later, through the highs and lows of the usual hype cycle of innovation, fintech and crypto assets seem nowadays to start gaining serious traction in the world of finance, and fintech start assuming a notable proportion in some jurisdictions, showing a capacity to grow extremely rapidly and deeply affect incumbents and the way in which financial products are created, bundled, and distributed, or even perceived by the public. And by way of example, this has been clearly shown by the growth of some Chinese money market funds, by the upcoming IPO of Ant. Access to finance has been simplified and widened by peer-to-peer lending and crowdfunding, although even those has had its teething problems, and crypto assets are becoming mainstream investment tools, though they are still struggling to establish themselves as fiat money substitute in their native form. So a lot of innovation is going on in this regard. And this is even without mentioning the boost that has been granted to any form of digital finance and digital payment by the COVID health emergency. So looking at this evolution, I think that the events over the last 2 years have confirmed the validity of the original insight. The fundamental functions that are traditionally of the financial sector are unlikely to be affected by the technology employed. These are fundamental economics needs that are going to stay with us. Fintech has, however, a very strong potential for bringing quick changes in the way in which products are created, bundled, and distributed, and for making business shift quickly and even suddenly between different forms of intermediation and intermediaries. And these changes, we have seen, can generate benefits in terms of access to finance and efficiency of the system, but they can also disrupt its orderly functioning. And this, I do believe, leads to a potential conflict between 3 different strategic objectives: openness to innovation, market integrity, and the consistency of the rules. And I think that these, as already has been said by Antonella, makes necessary an approach that is not completely hands-off, but tries to govern change brought about by digitalization of finance, and tries to balance or compromise between these strategic objectives in order to maximize the benefits from fintech development while minimizing the risks. And I know this will be construed as a case of own bias, but I believe that the 2018 action plan and its subsequent implementation leading to the current digital finance package did try to navigate a balanced path between those partly contrasting objectives. And in particular, if we look at the 4 main stated objectives of the digital finance package, it's possible to interpret them in light of the overarching 3 strategic goals that I just delineated. And the digital finance package has 4 main stated objectives: creating a digital single market, creating a European financial data space, a regulatory framework facilitating innovation, and addressing the risk of digital transformation. And it's possible to see that the single market and data space should allow a sufficiently large space for fintech innovation to develop, compete, and grow to scale more easily, while the use of innovative legal instruments, such as a pilot regime, will allow to keep flexibility and openness to innovation. At the same time, a sandbox approach limits the impact on internal consistency of the existing rule, while offering transparency and enhanced legal certainty for both innovators and incumbents. And finally, awareness and constant monitor of the possibility of risks allows targeted regulatory interventions, like those that are on the table now, that address concern of market integrity and financial stability, while attempting to limit disruption to consistency of the legal framework. So, keeping in mind the trilemma that was noted above, I think it becomes easier to appreciate the need for an approach that tries to balance different needs. And naturally, as all necessary compromises, the solution proposed by the Commission could fail to satisfy some stakeholders. So that even more important than these objectives, I personally find that the way in which these have been pursued and the way in which the framework has been developed are important, and is important that should not be overlooked. And it seems to me that the central idea of the regulatory approach is aiming to streamline digitalization and digital into mainstream financial application and products, rather than see it as a contrasting force. And this is in line with the general idea that the fundamental functions of the financial sector should not be affected by the way in which they are implemented, and is acknowledged by the strategy which proposes the principle of technological neutrality as a general principle. The same activities and risks should be regulated in the same way, rather than focusing on specific activity, on specific instruments or legal forms. And finally, what I also find important is that the highly dynamic nature of the process is recognized with the necessity of incorporating new elements as they come along, rather than taking a too fixed or too rigid approach ex ante. And so this overarching approach has basically been followed also over the last 2 years, and is that of keeping an open dialogue with financial sector stakeholders via dedicated forums, such as a forum for innovation facilitators, the FinTech Hub, expert groups, and consultations. And I believe that by adopting this innovative regulatory approach, the Commission managed to move along the main lines of what seemed to be the consensus in FinTech regulation discourse, and find a balance between potentially contrasting objectives. And I think that this should propitiate the creation of a favorable ecosystem that will allow us to reach the expected benefits of digital finance. Thank you.
Thank you, Marco. Thank you for your really interesting presentation and this general overview. I have just two very quick remarks. The first one regarding the last consideration about the method, about the procedure following to arrive to this digital finance strategy. I think that the Commission worked very well. I was involved in the ROFIEG, in the digital, in the expert group focusing on fintech gaps and regulatory obstacles, and I found some ideas, some suggestions that we proposed, accepted, received in the digital finance strategy, and I think that this is a very good way to go on. And another quick remark, very interesting, your slide focused on too small to care, too large to ignore, too big to fail, because I think that this is a very important point for the regulation. It's very important for the regulator to find the right moment for intervene, not too early, but not too late. It's not easy, absolutely not easy, but extremely important. So thank you very much. We decided to give the floor firstly to all our panelists and then to the audience for questions and interventions. And so I go on, and now I would present to the audience two academics, Filippo Annunziata and Dirk Zetzsche, both very well-known experts, I have to say, of fintech and crypto asset. We start now with Dirk. Dirk Zetzsche, University of Luxembourg, was one of the first scholars in the world to deal with fintech and fintech regulation. And I would ask Dirk to help us understand what are the key legal issues on crypto assets and which regulatory approach is preferable. So, Dirk, the floor is yours, and thank you very much for being with us this evening.
Okay, ladies and gentlemen, let me just start with my presentation. All right. Okay, so ladies and gentlemen, we have heard that there is a EU digital finance strategy. My job is now to ensure that we can put MiCAR into context before Filippo will go with the scope of MiCAR. So, ladies and gentlemen, what is the issue? when we put MiCA in the context of the global discussion of global stablecoins, then we need to understand that global stablecoins are one step from intermediary to platform-based payments. Those intermediary to platform-based payments means that in the past, basically one intermediary was linked to the client, but in the present or in the modern times, we have large platforms with multiple functions functioning as intermediary, or basically the overall platform functions as intermediary. In this regard, it's very important to mention one particular product, and that is Libra. This is basically the Libra setup, and here you can start with a Libra holder on the left side, which has then basically a kind of digital wallet with a crypto exchange, and that crypto exchange then buys and sells from a kind of reserve, which is nothing else than a pool of securities bank deposits. And behind that are a number of custodians and other service providers, which are usually regulated financial institutions. And when you start looking at this picture, you see that Libra is apparently very novel, but it ends very much in the traditional financial system. And that is the reason to regulate, because when anything happens on the left side of our screen, it may impact on the right side, that is a traditional financial system. So here we have one major problem when you try to qualify, for instance, something like Libra, a global stablecoin. You find a number of different qualifications. And these different qualifications include, for instance, commodities, derivatives, transferable securities, financial instruments, fund units, payment units, units of accounts. Basically, across the regulators, you find almost every qualification, because some elements of these qualifications or definitions are present in the Libra scheme in some form. So here, now, what is the job of regulation? We need to protect the clients, the systemic risks, and we need to ensure that there is an integrity of the market. That means no money laundering. Okay, so while a lot of stuff has been done on the international level in the last year, in particular from IOSCO, from the FSB and the FATF. They focused on investor and client protection, financial stability, and market integrity. But the word market efficiency has yet not been at the focus of attention, because the idea is that every innovation justifies itself by enhancing market efficiency, means deeper and better capital markets. And here, that may be also a problem when we see global stablecoins. But of course, the idea of a global stablecoin is really to provide this global currency rather than the various national currencies. So here we may also see why global stablecoins, for instance, could further market efficiency. So where is MiCA in all of this? We already heard. Here is MiCA one building block. It is the proposal for a regulation of markets and crypto assets. And so in this regard, it is basically a very clear situation. So let me just here say that the EU Commission thereby opted into one of several options. Legislation and so on. Now the Commission decided to adopt bespoke legislation addressing stablecoins and global stablecoins, but leaving other type of tokens of the token industry, in particular financial instruments and securities token, out of scope. And that you will see creates a certain problem which Filippo will address. So let me just go with you quickly through MiCA's table of content, because it tells a little bit of what is important. We have there the term crypto assets, the term asset reference token, and electronic money tokens. This is a bit of regulatory Chinese here, so we have to put this into context. The typical crypto assets are now in 3 different buckets, and these buckets can best be understood that the crypto assets is the basic term. It means any digital representation or value of rights, while the asset, the e-money token, is a traditional stable coin, and the asset reference tokens is a global stablecoin, in that sense that the asset reference tokens refers to several fiat currencies in an effort to create a stable value, while the e-money token, the EMT, is just referring to a fiat currency. That might be a $1-to-1 or $1-to-1 euro token. So why do we have these different types? Because they create different types of problems. If you have just one currency token, like €1 on one token, then you don't have the currency risk. Well, when you have several ones, you have a significant FX risk here in the basket. So when you look at that, one thing becomes apparent. You have asset reference tokens, e-money tokens, which are the traditional stable coins, and other crypto assets, which are USIX tokens. That leaves the question open, where are the security tokens, the typical investment tokens? They are still in principle subject to the general EU securities law. Let me just go now into a few pieces of the MiCAR. On the one hand, when you have now the general crypto assets token, you will find you have a special prospectus regulation. And this special prospectus regulation is, of course, something that you have to consider as a kind of additional prospectus regime. So it produces so. When you go now into the asset reference tokens, which are the global stable coins, you have an interesting new authorization requirements, because the 4 asset reference tokens for global stable coins will in the future be subject to separate authorization. That means that if you don't need an authorization under other pieces of legislation, now you need one under MiCAR. So the issuance of RRT is a regulated activity and must be provided by a legal entity located in the EU. That comes with a number of operating conditions, and many of them are among the typical things that you would see in terms of financial regulation. Maybe most noteworthy is the own funds requirement. You have here a €350,000 base fee plus 2% of reserves assets, and that means we'll need for several billion global stablecoin already a significant amount of own funds. Interestingly, you have also details on reserve management. For instance, you need to minimize market and credit risk. And when you start thinking about what it means, you definitely need to be into state debt to achieve that, because only they are defined as having minimal market and credit risk. There will be a very, very small number of private actors issuing AAA. That means indirectly this goes into state-backed securities in the one and the other kind. Then the reserve must be segregated from the assets of the organization and the fund, but that is the typical thing what if you have a reserve. So then we have now one aspect is that we have asset reference tokens when it comes to the holders' rights. Here it is important that MiCAR does not set certain conditions how this policy must be, but in generally speaking, MiCAR follows a disclosure approach. That means the organization must provide these terms, but where rights are not granted to all token holders, you need to offer a statutory redemption right if the market value of the token varies significantly from the value of the reference assets. That means we have here a kind of semi-open-ended structure, and that requires a designated market maker. So crypto asset services are, in that sense, an authorized activity. And these crypto assets means that anyone in relation to these crypto assets will also be subject to full supervision regulation. Here you will see what are crypto asset services from custody over trading, over exchanges. So basically everything that we saw in the Libra chain will be in the future subject to regulation, even if it doesn't qualify under other pieces of legislation. Interestingly here is if you have a significant global stablecoin issuer, that will be under direct supervision of the European Banking Authority. So here it seems to be that the national supervisors are too small to really deal with the European-wide scope. We have a similar asset referenced token here in the respective chapter 5 for the global stable coins, and we have something similar then later for the e-money tokens, the simple stable coins. And the important point is that MiCAR does not tell us what significant asset reference tokens are, but EBA is to classify what is significant under these terms. So electronic money tokens are subject basically to the same. And now comes maybe one aspect which I find peculiar. When you start thinking about what a global stablecoin implies, that this means global cooperation among supervisors. But when you look into how this can be organized, you find that there will be a supervisory college, but the college consists of the EBA as a chair of the college. I have not found provision in languages that would accept the lead of a third country authority, let's say Switzerland. And that means, if I understand this correctly, that we assume that the Europeans get the lead. I think we can all be certain that when we have a strong US focus, the US will claim the same for themselves. So 3 comments. First of all, what is a crypto citizen is a challenge, but we have with Filippo, a person with us who will deal with that a bit later. What I find a bit interesting when you deal with MiCAR is that it's somehow placed in the middle of European law, but you don't know where it is. So for instance, we have some language which is not entirely clear. Yeah. So for instance, we have a small issue exemption for 5 million. You don't know why it's 5 million. Yeah? When we look at the new Article 3 of the prospectus regulation, there is an exemption for prospectus of 8 million. So where do these 5 million come from? We can only assume that this is because the MiCAR draft is older than the adoption of the prospectus regulation or whatever. We don't know. Yeah? Then another problem is you don't know with this type of provision that the offer to the public is solely addressed to qualified investors and so on, and you don't know the and or oath or in this regard, and you don't know the basically the rationale. You can read from the documents that A and B must be together applicable in order to justify a small issuer exemption. Can be separate in order to be a small issuer exemption. That means that global stablecoins solely addressed to qualified investors are exempted from the MiCAR, which then brings us to the second problem, that we may have supervision of significant global stablecoin providers. At the same time, they are not subject to the rules of Article 15 of the respective MiCAR rules. So another last point before I close is a connection between MiCAR and central bank digital currencies. Why is that important? Because MiCAR provides a private coin, while central bank digital currencies are a kind of public coin. And one thing is clear, you are fully exempted when you do issue tokens on behalf of central banks. But the problem is what happens with CBDC services that are not provided on behalf of central banks, but maybe in connection with the central banks without being on behalf of central banks. And here is now the typical structure that you would consider when you have a central bank digital currency. The typical currency that we often have seen now in the last time are so-called first-level CBDC models, where the bank engages with certain top-tier intermediaries. The second is then the so-called retail model. Here, the central bank interacts already with retail and wholesale clients, and that means that the central bank has a full operational problems to solve when you deal with millions and millions of retail clients. So the most likely CBDC model that we have predicted in our research is a so-called 2-layer CBDC model, where we have a first layer of tokens being issued between the central bank and the intermediary, and a second one where the intermediary is acting with the clients, and they are linked through different financial constructions to ensure that there's always a one-to-one scheme. When you start thinking about that and try to put that into MiCAR, you would probably come to the result, as long as there is not a balance sheet link and on behalf is met, that we may find those intermediary that serves the clients subject to MiCAR. Then that means the whole process would probably be quite heavily regulated. And that would also make a central bank digital currency, this model, more expensive than we would know it from current e-money, and that would put it as an immediate disadvantage. So let me stop here. We see that global stablecoins made the need to regulate the token economy too obvious to ignore. Yeah, we heard from Marco that too big to fail step had been reached or potentially be reached in a very short time. Second, we have now with MiCAR catching up of the European level with the most recent policy bodies, the FSB, FATF, and we have here basically MiCAR as a gap-filling exercise. We have a bespoke regulation specifically for global stablecoins, which addresses certain pain points in financial regulation. There are a number of things we think we need to improve. On the one hand, it is not entirely clear how this all relates to general EU financial law. Then we, I think, need to strengthen cooperation with third countries if we want to make a global stablecoin happen, because otherwise we have just a European-based non-global stablecoin. And we need to reconsider what kind of CBDC models we want to allow in which way, and maybe provide carve-outs. With that, I hand over to Filippo, and thank you very much for your attention.
Thank you, Dirk. Very, very interesting presentation. I think that regulate crypto assets is absolutely not easy. It's challenging also for the Commission. But in your presentation, you dealt with very important and discussed the choices made by MiCAR. And first of all, qualification. This is a very, very big problem. And I think that it's a big problem, but we have to define crypto assets. This is a job that we have to do. Second point, very interesting from my point of view, the choice to go in the direction of new licenses, new providers, new licenses, new reserve of services and activities. And this is another important point. And at the end, the very, very sensitive relationship between MiCAR and central banks. And about this point, I think that Maria Teresa Chimienti at the end will say something. Now, the floor is Filippo. For Filippo, also Filippo Annunziata. Filippo Annunziata, Bocconi University is a very well-known expert, not only in Italy, but also all over the world. Great expert on financial markets, and recently also expert in crypto assets. And so the floor is yours, Filippo. I'm very interested to listen to your opinion about this proposal about this issue.
Okay, thank you. I think the audio is fine, so I will share my screen. And yeah, well, basically, I mean the big issue that we have, one of the biggest issues that we have when it comes to understanding and regulating crypto assets is that of qualification. And this is something that we've been struggling with, not just in Italy, but across the world since the very beginning of this new technology. And we have reached some sort of basic understanding. There are some sort of basic agreements as to how we should identify and qualify these crypto assets. And naturally, this is an exercise that needs to be done, because if you do not define and qualify, you won't actually be able to regulate these assets properly. So this is a typical exercise of, you know, the legal world, the legal profession. We may be sometimes too formal vis-a-vis a purely economic approach, but we have this tremendous need to define, to identify what we need to regulate, and then provide the regulation. So if we take a look at, for example, the the advice that ESMA provided to the Commission at the beginning of 2019, we clearly see how complex this world of crypto assets is, and therefore how difficult it is to provide a definition of these assets. In 2019, ESMA probably already underestimated the number of crypto assets that were sort of available on the market. They said we have more than 2,000 assets. I think that if we were to run through the market today, this figure would be bigger, but also we would see a diversification as opposed to what ESMA observed in January, because from what I see, the number of tokens issued in the context of ICOs has dropped sharply. ICOs were sort of the big hit of the market in 2016-17, and then they began to decline by way of a number of reasons, including the big percentage of failures of ICOs on the market that sort of made investors a little bit more wary. But this doesn't mean that ICOs tokens won't come back in the future. Also, when we look at how the markets of crypto assets function, and you, for example, take a look at a typical trading platform, such as the one that you see on this slide, what you see is that the market of these assets looks pretty close, secondary markets I'm talking, and trading platforms, looks pretty close to what we find in traditional financial markets. So you see that these assets are exchanged, that they have a price, that they are priced vis-a-vis previous references that give you the yield over a certain period of time. And you also see that there's an indication of capitalization on the market, and naturally this is quite an old slide because the price of Bitcoin has gone up since I took this picture, and I assume that also the capitalization has increased significantly, but they're also very volatile, and we know how these prices go up and down, and we also know how much arbitrage there is between different trading platforms, because different trading platforms provide different prices at the same time of these same assets. Now, the point where it seems that we all agree, at least in literature, but also MiCAR follows this approach, so I have to say that this is something in some way consolidated, is that we have three big categories of crypto assets. We have payment tokens, we have utility tokens, and we have asset tokens or financial tokens, call them as you like. And this was something that Dirk was already referring to. It's nothing new. Any piece of literature that you read on crypto assets follow this approach, that it must be said has to pay some kind of reward to FINMA, the Swiss authority that was the first one who actually came out with this proposal of categorization of crypto assets. But this sort of keeps us in a world where we know that some of these assets, the asset tokens, if they qualify as financial instrument, they are already within the scope of existing capital markets regulations, especially MiFID and prospectus, to say the least. But I would also add in, there's an important part in MiCAR that I think should not be disregarded when you look at that regulation. I think that we should always keep in mind that if they are financial instruments, they will also fall within the scope of the market abuse regulation. And there's a whole set of rules in the proposal of MiCAR that are taken directly out of the market abuse regulation of 2014. But that's a very interesting point, because most of the times, the kind of information, relevant information that would need to be disclosed on the market in relation to these assets is quite different from the kind of information that you would expect in the traditional world of the financial instruments. But by the way, this exercise seems to be, as of today, quite easy, but there are a lot of tricks that this exercise may play. For example, under national law, you may find that there are other categories that you have to deal with that go beyond the scope of EU financial regulation. And well, we are in Italy at the moment. I'm in Italy at the moment. Antonella is in Italy. Many people are in Italy. We have another notion which is wider than the notion of financial instrument, which is quite similar to the Howey test under security US legislation, which is the notion of financial product that would capture a lot of assets that would not fall within the categories of MiFID or of the prospectus, but that we would consider as financial assets in nature because they are a form of financial investment. And this makes the dialogue at a European level difficult because we speak different languages. Systems who have this broader approach, such as Italy, would tend to sort of capture within the traditional categories a wider range of assets. Other systems which are more rigid or more sort of anchored to the EU definitions would follow a stricter approach. Also, another problem that we have is that tokens are subject to mutations. Once we have struggled and understood whether a token is effectively a utility token or a payment token, it may change its nature over time. Once it circulates, its function may change. For example, we have a lot of examples of tokens that would fall under that taxonomy in the category of utility tokens, but at a certain point you see that that people who hold those tokens may use them as a means of payment to regulate and to settle transactions on the market. So at that point, the token undergoes a sort of genetical mutation because it begins as a utility token, but then it ends up being a sort of a payment token. And this is also the case of tokens that we think are clearly identifiable as non-asset tokens, such as Bitcoin, but actually we still do not know whether Bitcoin is closer to a means of payment or to a financial product, whether people hold Bitcoin because they think that they would use it in the future as a means of payment. We have news coming up every day. One came up last week, for example, when PayPal said that they would be ready in a very short period of time to allow people to use Bitcoin as a means of payment on their platform, and everybody understand how disruptive this can be. But at the same time, many people think, and I think that this is a good approach as well, that Bitcoin is actually a form of investment. And our friend Ametrano, who is on the line, would probably speak of digital gold. And so that's quite a different perspective. Also, national law makes things more difficult because we know that under national law, the identification of a financial instrument. So let's look at the part where we think we are more solid, where we have EU legislation in place, MiFID and prospectus. But under national law, the concept of what is, for example, a share or a security similar to a share, or what is a bond or a security which is similar to a bond, creates a lot of uncertainties. Different legal systems have different approaches. In some legal systems, for example, in order to have a share, you absolutely need that the instrument provides some kind of financial return, such as dividends, out of the profits of the common enterprise, and also some kind of voting rights. If you cut out one of the two, then some legal systems would be uncertain as to whether that instrument is similar to a share or a share in itself. And this creates a lot of difficulties because if it's not a share or similar to a share, then it would not be a transferable instrument or a financial instrument under MiFID and prospectus. So we have these EU categories that then need to be applied according to national law. And this would bring us back to national company law most of the time, and also to the law of contract, and the conclusions that we would reach might be different. Another difficult point is that in order for you to have a financial instrument or of transferable securities under MiFID or prospectus, these assets would need to be negotiable. And you just have to look at the ESMA's opinion of January 2019 to understand how the concept of negotiability is difficult to frame, and there are different interpretations provided not just by supervisors but by legal experts. And then you might think of what happens when a court, a national court or a national judge needs to apply and interpret such a vague notion as negotiability. So even in those areas where we think that we are more solid and we have MiFID and prospectus regulation under EU law, the world is very difficult because crypto assets have a vague profile. Many times they are difficult to understand, and they are also subject to mutations. And one of the biggest mutations that they undergone is when they are traded on secondary markets. And this again is typically what you find on a trading platform, a page where you have Bitcoin, and you can buy and sell, and you have a graphic with a price, and you have the whole history of how the price has moved. And it really gives you the impression that even if the underlying nature of this asset is non-financial, the way in which it works on secondary platforms is very, very close, if not undistinguishable from a financial asset. And here I have a theory of my own that I repeatedly set out when I tackle these topics, that sometimes even utility tokens, when we clearly see a utility token and we are confident that that's not a financial instrument, but when it's traded on a trading venue in this way and it has a derivative component, it might turn into a commodity financial derivative under MiFID. But this is my theory, but I think that we should keep this in mind. So what happens with MiCAR is that finally the Commission has taken the matter into its hands and is now moving towards a new European regulation in this matter. And I think this is positive because it provides a certainty to the market. And also, if we find in Europe political agreement on this proposal soon enough, we might actually be truly the first very important jurisdiction in the world to provide a sort of a comprehensive framework for the regulation of crypto assets. And we would be far ahead, for example, of the United States, where instead a case-by-case approach full of uncertainties is still being followed. As you well know, the situation in the US is basically the SEC, which comes up, steps in, and considers crypto assets on a case-by-case basis, applies or not. This applies the Howey test, but the idea of having a comprehensive framework, I think, provides a lot of certainty to the market, and the European Union might be really a front runner in this area. But the problem that MiCA has at the moment is that of definition, because there are definitions, very important definitions in the regulation, and Dirk has already recalled the general definition of crypto assets, the definition of what is a utility token, and there are definitions which are quite satisfactory in relation to asset-backed tokens and e-money tokens. And that's where MiCA gives a more comprehensive set of rules, because it provides definitions which are precise enough and builds upon those definitions a comprehensive regime of how these tokens would need to be regulated, including the offering on the market and service providers and so on. But if we forget for a moment about asset-backed tokens and e-money tokens, the approach that the draft regulation takes in relation to the other crypto assets is a little bit too probably vague. And because Article 2, when it comes to these other crypto assets, actually provides a negative definition, or rather a negative identification of its scope of application. Article 2, paragraph 2 simply says that this regulation shall not apply to crypto assets that qualify as financial instruments within the meaning of MiFID. But we just saw how difficult it is to complete the exercise of qualifying a crypto asset as a financial instrument or not. So by simply saying that the regulation should not apply to those crypto assets, what MiCA sort of leaves completely open, or at least substantially open, is the identification of its precise scope of application. Because we do not really know what would fall within financial instruments under MiFID. And on the other side, we do not really know what would fall outside and therefore within the scope of application of MiCA regulation. And in relation to crypto assets, which are not asset-backed or e-money, this, I think, is an area of quite significant uncertainty. And this uncertainty is sort of increased as a consequence of the fact that for these crypto assets, the non-asset-backed and non-e-money, the draft regulation keeps a very light touch. Very light touch. These crypto assets would be issued on the market after the publication of a white paper, and the white paper would not be checked by any supervisor, at least on an ex-ante basis. Supervisors would keep their ex-post controls, including those that relate to the identification of a crypto asset as a financial instrument, but on an ex-ante basis, these assets would be placed on the market with no previous filter and no verification on the white paper, but not just on the white paper, on the substance of the transaction. And the ex-post controls could come up too late, eventually, in case of market failures, and also leave a lot of uncertainty when it comes to requalifying, the risk of requalification of a crypto asset that may have very serious consequences under national law, because in many countries, if a crypto asset is placed on the market as a pure utility token, it is not considered as a financial instrument. This is what is set out in the white paper. And then it turns out that it should have been considered as a financial instrument, let alone with all the difficulties of understanding what a financial instrument precisely is in the context of MiFID and prospectus as we know it today. This may have criminal consequences and also consequences under contract law, because, for example, in countries such as Italy, then we would say that if this requalification is effectively necessary, there would be the risk of a criminal offense, but also the transaction would be considered null and void under general contract law. So there would be a huge market disruption, and I think that we should avoid this and probably put more effort in trying to understand the dividing line between the regulated world of financial instruments and what MiCA would like to capture. There is a suggestion that might be considered within MiCA, and this is something that you find in the context of asset reference tokens and e-money tokens, because in that context, article, for example, 30, when it considers the application that a legal person needs to set out when it comes to issuing these tokens, among the information that should be included in the application, you find reference to a legal opinion that the proposed activity would not fall within the scope of other financial services legislation. Now, this is interesting, and there are, pros and cons on this kind of approach, because for asset reference tokens, this opinion we would probably need to clarify. Maybe it's obvious, but I'm a little bit concerned about the function of this legal opinion, that this does not obviously reduce or limit the duties and the tasks of supervisors when it comes to granting the license. So this legal opinion is a sort of an additional exercise that should not substitute the one that supervisors would need to do. But if you think about the crypto assets which are not asset referenced or e-money, there is no trace of this legal opinion in relation to the publication of the white paper. So the question that I have is whether we should consider applying this scheme of the legal opinion in that context as well. But if we do so, I think that we should strengthen the provisions that are in the draft regulation in terms of who would provide this legal opinion, and facing issues of conflicts of interest and independence and selection of the people who would be actually in the position of providing a legal opinion that would really touch the essence of what crypto assets are and their qualification. So ultimately, I think that MiCA is a very interesting and very good step forward, because finally we have lost our uncertainties, and we are now deciding to take this problem into our hands, but we need to be very clear as to what we need and we want to regulate. And by simply providing a negative scope of application of this regulation, I think that we are not truly fulfilling this task. So I fully agree with what Antonella was saying. Identification, classification, and definition in this matter is essential. It's essential per se, but it is also essential because the categories that we think we know very well, financial instruments and MiFID, actually we don't know them as well as we should before we tackle the task of regulating crypto assets. Thank you.
Thank you, Filippo. Obviously, I totally agree with you with your thoughts. I think that qualification definitions are absolutely necessary to build the right and adequate framework for crypto assets. And I think that this proposal is a first step, but is not an effective solution. Also because, as you underlined, we already have many problems of classifications before and apart from MiCA. The interplay between EU law and definitions, financial instruments and so on, and national law, so for example, financial products in Italy, is not clear at all. And so on this ground, on this basis, it is really important to find in MiCA proposal new definitions and precise definitions and qualifications, and the negative approach, a negative definition, I think that don't work. And just a joke, I think that the legal opinion is a very good opportunity for us, for lawyers, experts in financial law, because it means a lot of work for the future, but it's a joke, obviously.
Yeah. It's also very risky, Antonella, because
yes,
if you provide a legal opinion and it's wrong, then, you know, consequences may be very, very difficult.
Yes, I agree with you, but as said before, it's a joke. Now, I think that it's time to give the floor to the last speaker of the session. The last speaker is Maria Teresa Chimienti. She works at the European Central Bank, and she recently published an occasional paper on stablecoins. Obviously, the views expressed by Maria Teresa don't necessarily reflect that those of the European Central Bank, but I think that Maria Teresa could help us in this session to better understand the point of view of a central bank on stablecoins and the implications for monetary policy, financial stability, payments, market infrastructures of these kind of crypto assets. So thanks, Maria Teresa, to be here, and the floor is yours.
Thank you very much, Antonella, and good evening to everyone. There is my screen. So now I will try to also share my presentation. This is currently not working, unfortunately, although we had the chance to test this. But now
maybe someone could help Maria Teresa.
Take your time, Maria Teresa. What is going wrong?
I just see the right now the screen going back and forth, on and off, but not giving me a stable screen, unfortunately.
And Take your time, relax.
Yes, absolutely.
What are you sharing, PowerPoint or a PDF?
I have your slides. I can try to share my screen.
Yeah, it seems a problem. It seems to be a problem maybe with my laptop. It's just the video is coming. It's not very good.
Okay, so Antonella, if you share the slide, otherwise I will do that, as you prefer.
Okay. I share my screen.
Fantastic. Yes.
Thank you so much.
Okay.
Thank you. Thank you very
Please
much.
go on.
I mean, we tried it and it
I
worked.
follow your indication to go on through your presentation.
Sounds good. Thank you very much. So you already made my, let's see, my disclaimer, but I would like to make one more. And it is that I am a market infrastructure expert. So in a sense, I'm a payment system practitioner, if you wish. I do not pretend to be a financial stability expert or a monetary policy expert. And what I will try to explain today is actually the outcome of an analysis that has been undertaken within the ECB by the so-called Internal Crypto Asset Task Force, which is made up of 13 business areas within the central bank. So I apologize in advance if I'm not able to answer all of the questions that you may have on monetary policy or financial stability or banking supervision, but indeed this was a major work that entailed the help and the support of so many people within the ECB. Now, when it comes to the presentation for today, what I would like to do, I would like to set the stage a little bit by talking about the classification of assets that we have within the ECB. And you may or may not see some similarities with the approach that MiCA has undertaken. And then also present what the ECB taxonomy of stablecoin is, with a focus on what that implies for regulation. Then I will move on into the risk assessment or the analysis of stablecoins, how we get there, and what kind of implications we are focusing on when it comes to crypto assets and stablecoins. And then I would move on to the general, let's say, regulatory approach that we would like to see within the ECB, or the authors of the paper would like to see, and some oversight considerations. So considerations on the Eurosystem oversight, on payment systems, payment schemes, and payment instruments. And finally, I will conclude. So I would suggest to go to the next slide. Perfect. So the classification of assets, I would say, what is our approach to the classification of assets or digital assets within the ECB and the Internal Crypto Asset Task Force? So this classification is very much hinged on the concept of liability of the issuer or liability of an entity. So starting from the left-hand side of the slide, you find that cash and central bank deposits are liability of the central bank, a liability of the central bank. In the case of cash, this liability is in physical form and is available to the general public. In the case of central bank deposits, it is in digital form, but is limited to only certain counterparties. So typically the monetary policy counterparties of the central bank, or the participants in target 2, the payment system. Now, moving into the future, looking ahead into the possible future, what we would see is that the central bank digital currency, CBDC, would then combine some of the characteristics of cash and central bank deposits. So like cash, it would be available to the central bank, to the general public. And like central bank deposits, it would be represented in digital form. Now, moving on to the other side of the slide, to the right-hand side of the slide, you find crypto assets. Now, in our classification, in our categorization, crypto assets are digital assets that are not or do not represent a financial liability of an issuer or a claim on an identifiable entity or any other proprietary right on any entity. So I would say the most important part of our characterization or our approach to characterizing crypto assets is the lack of this element of liability and claim. Of course, DLT is an important, or distributed ledger technology is an important component of the definition of crypto asset, but it's not per se. It's a necessary, I would say, component, but not. It's not sufficient in itself to define what crypto assets are in our characterization. So then we come to the center of the slide, the center of the table, where we come again to what is a liability of a private entity. So commercial bank money and e-money are examples of a liability of a private entity. And within this category, we could also put some so-called stable coins that entail a claim or liability on an identifiable entity. In fact, if you look at the stablecoin market as it is right now, you would find that most stablecoins currently in operation are not or lack that element of the definition of crypto asset that I mentioned before, which again is the lack of a claim or liability. So most of the stablecoins that are currently in operation do present that characteristic. So lack the major characterization element of crypto assets as we define them. And this is regardless of whether that specific claim can be exercised or not by the end users. Read Libra discussion. Moving on to the next slide. So here in this slide, we have a very quick summary of the ECB taxonomy. I will not go through the single categories of stablecoins that we have identified. For the sake of our discussion, what I would say is that based on the design, stablecoins can be characterized into 4 types. They can be either tokenized funds, off-chain collateralized stablecoins, on-chain collateralized stablecoins, and algorithmic stablecoins. And here I would just focus your attention on the center, on the column at the center of the slide, where you have there, in essence, what backs the value of the different types of stablecoins that we have identified. So for example, in the case of tokenized funds, you would see that this type of stablecoins are normally issued upon the receipts of funds, such as cash and electronic money or deposits. They are funded, they are collateralized by funds or close substitutes of funds, and typically they would be redeemable at the market value of the collateral at the time of redemption or face value of the stablecoin. Now, without going into all of the type of stable coins that we have in our taxonomy, I think what is important here is to understand the main messages that we can derive from this characterization of a stable coin. So the first one is that, as I mentioned before, most of these stable coins actually do not share the most important characteristic of a crypto asset, which is again the absence of a claim or liability. So they do necessitate, take the case of tokenized funds, they do necessitate an accountable issuer and or they necessitate a custodian that is responsible for safekeeping that collateral in order to then satisfy the redemption requests by the holders of stablecoins. The second message that we can derive from the first one is that when it comes to regulation, then the stablecoins that do entail a claim or liability on an identifiable entity should be subject to the greatest extent possible to the existing regulatory requirements. Now, we imagine that these regulatory requirements could be amended if there are, for example, increasing risks that could be identified that would justify amending the regulation to increase the requirements that could be imposed on stablecoins. But we will see this a bit later. And finally, one more message out of this characterization is that right now we're pretty much focusing on the asset layer of stablecoins, but we know that stablecoins are very broad arrangements. They entail different functions. They entail an issuance function, a stabilization function, but they also entail a payment system function. So I would say that regardless of this classification, we should also keep in mind that stablecoin arrangements are payment systems at their core. To the extent that they facilitate the transfer of value between participants in a system. Next slide, please. Now, this is a bit of a demonstration of the fact that we need a different approach when we think about stable coins than the one that we had for crypto assets a year ago. And this is the demonstration, in a sense, is linked to our risk assessment. A year ago, I mean, the stablecoin report that you mentioned that was published just a few weeks ago is not the first, let's say, analysis of this type that we do. In May of last year, we also published a report on crypto assets, very similar to this one in the framework and in the objectives, but focused on crypto assets like I've defined them before. So the crypto assets of the type of Bocconi, Ether, and the likes. Now, what we saw a year ago was that, and this has been mentioned before in the panel, what we saw is that crypto assets are very volatile. They're very speculative. This entails risk for consumer, but because they are so volatile, they typically do not fulfill the functions of money, and they do not have implication on monetary policy at this point in time. Also, because the market capitalization is quite small as compared to the size of the financial system, we did not identify at that point in time a risk for euro area financial stability. And we also observed that financial institutions typically have a very prudent approach to crypto assets, so they typically do not engage in direct or indirect exposures to crypto assets. And finally, we also mentioned in that report of May 2019 that crypto assets can hardly enter financial market infrastructure, meaning that within financial market infrastructures, crypto assets normally do not undertake the function of settlement assets. They cannot be used as collateral. They could not be used as investments by financial market infrastructures. Now, the interesting thing is that if you look at the market right now for stable coins, then you would probably draw the conclusion that not much has changed. But we know that this is very temporary because of the announcement of global stablecoin initiatives that could change entirely this risk assessment. And you see there in the second column that we would have a very different approach to qualifying the risks that we could face as the result of the entry in operation of certain stablecoin initiatives. So first of all, we acknowledge that they could mitigate volatility of crypto assets, which was the reason why crypto assets could not become used as a means of payment. And they could very well target mainstream use cases when it comes to payments. They could also be used as a store of value under certain conditions. We may discuss if this is likely or not, but they could also fulfill the function. And in that sense, they could then impact monetary policy transmission. We will see it later. And they could also reach a scale of operation such that they could, in principle, have implications for financial stability. For example, via links with the financial markets. And they could also be qualified, as I mentioned before, as payment systems and or payment scheme. And then if they are qualified as such, if they function as such, then they can also present the same risks. Next slide, please. So how do we go about this? Because as I mentioned, if we just look at what we have in front of us, we may not see all of this, but we need to be prepared for what might be coming in the future. So we have undertaken a bit of a scenario exercise, and we have identified 3 different scenarios. So one is the crypto asset accessory function, then the new payment method, and the alternative store of value. So what I would, without going into the scenario, what we see is a possible, let's say, movement from the crypto asset accessory function into the new payment method. If stable coins can offer convenience and user-friendly solutions, if they are able to fulfill certain use cases that are maybe underserved in the current payments market, and if they offer credible risk mitigation. Next slide. I will go very quickly to the implications of stablecoins on central bank tasks, starting from monetary policy. I'm aware that I have a couple of minutes maybe to conclude, so I would go very quickly maybe to through these slides and then go to the conclusion.
Take your time. Also, 5 minutes. I think it could work because your presentation is very interesting, and I think that you have to take your time.
Okay, thank you very much. So the first area of concern for monetary policy is monetary constraints. So if we have, in the event of a non-interest-bearing stablecoin, this kind of stablecoin could set a zero effective lower bound on policy rates. What that means is that a large, let's say, adoption or take-up of on a non-interest-bearing stablecoin could induce a substitution out of assets that yield a negative interest rate to the point where further cuts in ECB policy rates will no longer transmit to other interest rates in the economy. Now, this is unlikely to happen. We discussed why we have doubts about this in the paper, and if you're curious about those, then I can go a bit into that discussion. The second area is monetary policy transmission via banks. I think this is self-explanatory. Why this would happen, we would see that happening more in the third scenario than in the second. In the second, there could be some, let's say, revenue considerations for banks that we may or may not be focusing on. This is not really the focus of the discussion today. There could be implication on liquidity, safe assets demand, and money market. In the second scenario, there could be some extent of reduced demand for ECB liquidity, but in any case, I would say that this will not affect the the short-term money market. However, in the third scenario, we could have a situation whereby a non-interest-bearing stablecoin would affect price formation, collateral valuation, money market functioning. And this would take me then to the last area, which is the implication for monetary policy operation. Not only we would, let's say, face a smaller Eurosystem balance sheet and less senior hedge income, but also the scarcity of safe assets, of eligible assets for central bank policy operations we could face also that kind of situation. Now, this third scenario, I would say we define, and for the reason that I've mentioned before, that we envisage that this would not necessarily be around the corner. Next slide. So when it comes for financial stability, I would say the key here of the discussion is the design of the stablecoin and who is the bearer of the risks that stablecoins would have as a result of investment of the reserve assets in non-zero risk investment. So, and in that sense, stablecoins do pose risk of liquidity run, and so the run could occur, for example, in the absence of a fixed value redemption guarantee if the holder of the stablecoin perceive that there could be a decrease in the value of the stablecoin, or if the arrangement does not guarantee a fixed value redemption, if the holders also perceive that you would not have the loss absorbing capacity that you would take in order to avoid a liquidity run. So this could have contagion effect throughout the financial system because of the size of the redemptions that would be triggered. Next slide. As I mentioned before, payment systems, stablecoin arrangements work very similarly to payment systems, so they present the same risks. And risk could occur, for example, as a result of a very diluted or very distributed governance that could have implication on the soundness of the governance arrangement. There could be issue stemming from the use of DLT, both benefits and risks, and there could be issue in a cross-border context. And there also, from a payment system policy perspective, it is clear that this would have an impact on the ability of Europe to maintain or let's say to have strategic autonomy and independence in the payments field, because of the fact that these global stablecoin initiatives are typically governed by entities that are not located in Europe. Next. So I come to the conclusion from a regulatory perspective. The position that we, let's say, hint to or hint at in the payment in the paper is that stablecoin arrangements should not come in operation until all of the risks that we have mentioned before and the concerns that derive from this risk have been properly addressed. And these are going to be addressed by regulation. They're going to be addressed by oversight. Moving on to the next slide. And focusing on oversight, as I mentioned before, stablecoin arrangements will qualify as payment systems, and then therefore they will be subject to oversight of systemically important payment system under the so-called SIPS regulation, or they would, in any case, may be subject to general payment system oversight according to the principle for financial market infrastructures of CPMI IOSCO. But they could also be payment scheme. They could be payment system and payment scheme, or payment system or payment scheme. Payment scheme are also overseen by the Eurosystem, and the Eurosystem has been working on a new framework that would take into account stablecoins and embed them in the oversight framework for payment instruments. The final slide. The conclusions of the paper is that we already have a range of instruments at hand to manage the impact of stablecoin on our mandate. So typically, this is the example of the oversight frameworks that I just mentioned. The application of this tool, however, needs to be underpinned by regulation. We discussed MiCA. We strongly support the principle of same business, same risk, same rules. And this is somehow what I mentioned in the beginning, where I mentioned that what are the implications, let's say, of our characterization of crypto assets and stablecoin, and we are aware that further work may be necessary on that front. We continue to monitor the evolution of stablecoins, and we must be able to respond quickly to the changing scenarios, and this might entail also coming up as a central bank with our own innovation in the space of payments. Thank you.
Thank you, Maria Teresa. Thank you. Your presentation is really impressive, and I would ask many things, but the time is more or less over, and so I prefer to give the floor to the audience if our participants want to pose some questions to our speaker. I think we have some minutes to do that, and so the participants.
If I can, I would ask something. If
perfect.
I will ask, especially to Maria Teresa, what is the feeling about the need of a coordination across central banks? We know that the Bank of International Settlement has a working committee, I don't know how to, a team supervising in a way effort on CDBC, but do you think that this is a field that will be matter of competition or a field that will be matter of cooperation across different central banks in the world?
Interesting question. First, I have, assuming I can go ahead, or you want to collect more?
Maybe you can reply, Maria Teresa.
Okay, thank you, Antonella. So the short answer to your question is that there is a need for cooperation, and this need of cooperation actually already embedded in the principles, the oversight, the internationally acknowledged or internationally agreed principles for overseeing payment systems. So these are the CPMI IOSCO principle for financial market infrastructure and also the Lamfalussy principles. So in that respect, we already have a clear indication that when it comes to stablecoin arrangements that fulfill the function of payment system or financial market infrastructure, then we have a sort of an obligation or a clear recommendation from the standard setting bodies that central banks should cooperate. And that is entailed, that is specifically mentioned in one of their recommendations. This is responsibility E of the principle for financial market infrastructure. So this is clear, and it is already the approach that is being followed with regard to some of the initiatives that are on the market. So I would be quite confident that this is well understood, that this should be the case of cooperation. When it comes to competition, I sense there that you're referring more to what happens in the space of digital assets and central bank digital currencies, but also there I've seen quite a deal of cooperation taking place, because it is clear that this kind of assets would change or would have significant implications on the international monetary system. And so in that respect, then cooperation would be quite warranted.
Thank you, Maria Teresa. I read one question in the chat for Dirk. Could you provide more color on the meaning and rationale for Article 36, prohibition of interest? Okay, Dirk, please, the floor is yours.
Okay, I cannot use my video right now. So basically, I haven't drafted the MiCAR, so you can only speculate about it. Of course, 1 second. Of course, when you start thinking about it, a stable coin shall be stable, and you can use the proceeds from the underlying investments for two things: for returns, or maybe for stability. So for hedging and whatever. And I think the picture of that is that the interest payment turns a currency more into something like a bond. So the picture of a currency is not, it's basically a non-interest yielding thing. Yeah. So, because when this is what I assume, it shall avoid that the global stablecoins generate a kind of market return. So this is my assumption. Of course, that shall make sure that the delineation between bonds and global stablecoins is not blurred. Otherwise, you can have a mixed bond basket and thereby get out of the regulation for transferable securities, which is prospectus and maybe also certain MiFID requirements. Yeah, so I think this is the background. But as I said, yeah, it's a lengthy proposal, and but the delineation to bonds makes most sense for me. Yeah? Okay,
thank you, Dirk. So I think that our time is over. And so I think that after having thanked again our speakers and also all the participants, many participants, also now, also at this time. And now I want to give the floor to Ferdinando for the official closing of the conference. And so, Ferdinando, the floor is yours.
Thank you, Antonella. Of course, this will be very short. The idea is that we have been excited for this conference. Thank all the participants, of course, all the speakers and panelists, the moderators, our program committee, and in general, all the people at the Crypto Asset Lab and at JRC, which have been working on the conference. I remember that Selected high-quality papers presented here are invited for submission to the special issue of the economic notes, which will be published in early 2022. And last but not least, I thank our sponsor, CheckSig, Drop Trading, and Deloitte. We look forward to a continued engagement with you all on all topics concerning crypto assets, hopefully leading to CAL2021, the third crypto asset live conference next year. So thank you, everybody, and keep up with the good work. Bye.
Bye.